In this session, I want to talk about the basic introduction to the futures and the options market. So, this is primarily with respect to the commodities market, right? So, with respect to commodities, we have a widely popular futures market, a widely popular options market. So, from the derivatives standpoint, there is a huge futures and options market existing for the commodities. Now, we know the definition of futures and options, so I'm not going to touch base upon those kind of definitions in this process. But what I would like to look at initially is what are the various risks, what are the various risks that are associated with the commodities business, which can very well be addressed by getting into the futures market. Now, if we typically see in a commodities business, there could be a lot of fluctuation in demand and supply. In the sense, probably let's say we talk about a particular crop which is more seasonal in nature. What we typically see is uh, the demand for that particular product could be there across the year, but when we look at the supply, because of the seasonal production, its supply could be only there in a few months in a year based on the crop season for that particular crop. But when we look at the demand, it might be there across the year. In some cases, let's say for winter related clothings or winter related equipments, the demand could be there only during a particular point in the year, particular quarter or 4 months in a year, whereas the supply of those kind of products could be there across the year. So typically when we are handling commodities, what we could see is there is a huge fluctuation in the demand and supply, and because of which there is a huge change in the prices also. And it may so happen that in case of let's say a forward transaction, there might be an agreement to buy something in future at a particular price, and because of the change in demand and supply, what could very well happen is the either the buyer may default or seller may default to a large extent, depending on how the variation in the demand or supply is happening with respect to what had been the case when the agreement had really been entered into. So from that dimension, probably getting into a futures market, because of the standardization that it offers, because of the exchange being acting as a counterparty in the transaction, and because of exchange using the concepts of margins to mitigate the default risk, because of all these things that are happening, the fluctuation in the demand and supply can very well be handled by entering into the futures market. Similarly, storage problems. Apart from change in the price or apart from change in the demand and supply, probably some kind of commodities, let's say agricultural commodities, they require to be stored. As I said, probably the production is very seasonal. Probably if I am looking at something like maize has a seasonal production. Only in a particular time of the year the crop can be grown heavily. But the usage of maize in the form of sweet corn is available throughout the year. So this particular commodity needs to be stored and then sold during the periods where the supply is not that heavy. So from that dimension, it should so happen that the storage costs also need to be taken into consideration for the purchases in future. So entering into a futures market will give the advantage regarding all these particular aspects. Similarly, for a commodity, what we could see is quality issue. The quality becomes an issue. Probably when I am talking about the same maize, I may have 100 different varieties of maize. But when I look at the futures market, exchange will standardize all these things. Exchange will accept only some particular varieties of maize or probably some particular varieties of any commodity where the clarity in the specification will come out. So while doing the delivery also or while taking the delivery also, there could be a clear cut agreement in terms of the quality of the commodity, which will help the buyer and the seller to settle the transaction quite amicably. Similarly, the standard payment terms. This is if we are getting into a regular one-on-one kind of an agreement, the payment terms may not be standardized. So, and one party can default at the risk of the other party. So, all these things will have a very significant impact, and all these things, even price transparency. Let's say only both the parties are getting into an agreement. Let's say A and B are getting into an agreement. A is a buyer, B is a seller. It may so happen that B may decide a price and A may have to agree to that price. So this pricing is more or less closed between these two parties. Whereas when I take the help of an exchange, the price is explicitly determined on the exchange based on the demand and supply associated for that particular commodity. And because of that, there is a lot of transparency that is built into the price, and there is a lot of no arbitrage mechanism that comes up as a part of the price. So even that could be a better concept that could be addressed through the help of the futures contract. And then even I am looking at the problem with respect to counterparty risk. Whenever I am talking about a counterparty risk, it's primarily one party not adhering to the transaction, whereas the other party is adhering to the transaction. That is what is being built up as a counterparty risk. And because here exchange acts as a counterparty between the two parties who are getting into a buy-sell transaction, and it's very rare historically that the exchange is defaulting on the transaction. So the default risk or a counterparty risk is almost mitigated in this process. So direct transaction either in the spot market or in the forward market with respect to the commodities is always posing lot many risks compared to dealing with the same in the futures market. So that is one major dimension that we need to look at. That is one major advantage the futures market provides over the typical spot or the forward market, and that is what is the benefit both the buyer and the seller will get by entering into the futures market. So just looking at some of the key characteristics. Now I am more interested in identifying the key characteristics of the futures market. We know some key terminology to start with. Any party who is entering into a buyer role in the futures market, we say that this party is long on the futures market. Long is a word which is used for a buyer. So we say this party is long on the futures contract and this party will be receiving the commodities. He is the receiver of the commodity. Whereas when I am talking about the seller in the futures market, we say the seller is short in the futures market, and we also say that the person who delivers, this is the party who delivers the commodity. So these are some of the names which we need to be comfortable with. And in case of futures market, there is a possibility to the position, close the position prior to delivery itself. Before the delivery date, before the maturity date, the position can very well be closed. For example, if A has entered into a long position to buy 100 units of some commodity X, let's say in April 2014. When I say offsetting, the same party A getting into a short position on 100 units of X delivered in April 2014, all else remaining the same, but instead of a long position getting into a short position or vice versa, this kind of set of positions put together, we say that this is an offsetting position. It's as good as this party has exited out of the contract, though in reality he did not exit, but this kind of position where there is a one long and one short for the same number of units, same maturity date, same quality, same quantity, all remaining the same, but one long contract and one short contract, overall they are offsetting each other. That is one major feature of a futures contract which cannot be done using a forward contract. So again, with respect to settlement on the maturity date, we can talk about two aspects. One being a physical delivery settlement, wherein the seller will deliver the commodity and buyer has to pay for the commodity, or the second one is more of a cash settlement mechanism. This is something where this offsetting position, whatever is the difference between the sell price and the buy price, that is what is going in the form of cash at the time of settlement. So depending on the specification associated with that particular commodity, there could be a physical delivery associated with it, or some kind of settlement in the form of cash can very well be done. And the good thing is the commodities, similar or same commodity can very well be listed on more than one exchange also. It need not be the case that one particular commodity be traded only in one exchange. It can very well be traded in multiple exchanges, multiple markets. So that means there is a scope of arbitrage opportunity also, trying to extract the price differences between the two markets. A set of arbitragers, their major role is try taking the advantage of the price differences in the different markets. Even that could very comfortably be accomplished if there are more than one exchange in which the particular commodity gets traded. So just to quickly reiterate some of the important aspects of a futures contract, or whenever a futures contract is specified, some kind of important terms that we need to understand. What is the underlying? In this case, it could be very well a commodity, any kind of a commodity, or probably today we see with equity futures, we see bond futures, we see currency futures, we see index futures, we see interest rate futures and what not. There are various underlyings on which the futures can very well be created. And what is also important is the size of the contract. Means what is the typical unit? So is it like 100 tons of maize or some X gallons of oil? What is the typical unit that is associated, and what is the lot size for a buyer or a seller? How many such units had to be bought or sold? Even this would be specified by the exchange itself. Probably they may say 100 tons of potatoes is 1 unit. So which means any buy or sell contract that is being put up on the exchange, it should be for buying 100 or multiples of 100 tons of potatoes. So these kind of things we need to clearly understand when we are getting into a futures contract. What is the settlement mechanism? Is it more like a physical settlement only, wherein the buyer has to pay the cash on the maturity date and seller would be physically delivering the commodity, or is there any cash settlement mechanism that is available which is like an offset mechanism? What we typically see is the cash settlement mechanism is the most common and the most prevalent mechanism today. Almost 95% of the trades on the exchange happen through the cash settlement process itself. And if it is a physical delivery, then probably understanding the delivery related terms, the date, place, right, and terms of delivery. All these things need to be very clearly understood if it is for a physical delivery. And finally, having an understanding about the grade or quality of that underlying, probably if there is some kind of a rating associated with it, getting an understanding of all these things also is very important as a part of entering into the futures contract. So from this dimension, we typically see that there are huge number of differences between the typical futures market and equities market. Sometimes people think that both these markets are more or less the same, though there are some level of similarities that are existing between these markets. What I clearly see is there are equally good number of differences that are existing between the market. Whereas the prime intention of getting into an equity market is more of capital formation. I want to raise capital. That's where I am getting into an IPO. That's where I am getting into equity capital to the first on the first front. I am typically getting into an equity capital mechanism. I'm raising equity capital for capital formation purpose. Whereas when I'm getting into a futures market, it's more of risk transfer. The hedger is transferring the risk to the speculator and vice versa, or probably it is more aiding in price discovery. So it is even helping in terms of price discovery, because it is talking about a futures price is an indication of the future spot price. See, sometimes there is an equation which says futures price is an indication of the expected spot price. Futures price is an indication of the expected spot price. So from that perspective, what we can clearly see is the futures market really helps in price discovery and risk transfer, whereas the equities investment is purely from a capital formation standpoint. And a second key difference that we see is shorting. Shorting is more like selling without owning, selling without possessing the underlying is very much comfortably possible with respect to a futures market, whereas the shorting of equities is possible only in rare scenarios. But that too, there are so many restrictions with respect to shorting, whereas no restrictions exist with respect to a short position in case of a futures market. And similarly, there are so many limits, daily limit, upward limit, downward limit. A limit is there on the price as well as position. So means we know that the futures price will fluctuate only within a particular range, whereas the same does not happen with respect to stock. There could be ultimately any big increase or any big decrease in the price to any large extent. So that is one more dimension that we could see as a clear cut difference between the futures market and the equity market. And when we look at the number of shares, it's always a limited number of shares. It's only that number of shares are being exchanged by different participants. Probably it's more of a transfer of share from one party to the another. But overall, the total number of shares that are existing in the system are more or less fixed in number. But that is not the case with respect to a futures market. There can be any number. They could be very high or they could be very low in terms of the number of trades that could exist in the futures market. So it's not a fixed number like the number of shares. So overall, what we could very well see is there are so many critical differences that are existing between the futures and the equities market. Though overall what we could very clearly see is some level of similarities also do occur, because we are just like we are buying a stock, we are buying a future, or we are selling in a futures market. So some kind of similarities. So if the price goes up in the future, probably the long position which has bought at a lesser price is getting a benefit compared to a fall in the price at the future date. All these things remain as the similarities between the typical equities market and the futures market. But as I have highlighted, so many differences also do exist between the two markets. And the next dimension that we need to see with respect to futures market is two important terms: differentiating between volume and open interest. For this, I take a very simple example. Let's say A and B have actually got into a contract. A is a buyer or A is long position, whereas B is a short position. 1 unit, right? So because A has got into a long position and for that B has got into a short position, the open interest is that number of long positions which are not yet closed, or number of short positions that are not yet closed. Number of long or short positions not closed. So here there is one long position and one short position that is not closed. So in this case open interest is going to be 1. And because there is one transaction that has happened, we say that the volume is also going to be 1 here. Volume is also going to be 1 because we are talking about one long and one short transaction that has typically occurred. Now let's say A or B has got into another transaction, let's say with C, where B is a long position, C is a short position for the same, for 1 unit, same commodity, everything remaining the same. Now in this case what has happened is this B's position is offset. B's position is offset. So there is a short, there is a long, so both of them have nullified each other. So it's as good as A is long and C is short. Means the number of long or short positions that are not yet closed is only 1, because with respect to B the position is already closed. It's as good as C has replaced B in the first transaction. That's it. So from that dimension, what we could still say is, in this example, after these two transactions, probably I'll say volume is 2, whereas open interest I'll still put it as 1 itself. So that is where in some cases what could very well happen is volume could be much different from open interest. Open interest is clearly talking about number of long or short positions which got opened but not at close, and what we will typically see is number of long positions will be the same as number of short positions itself. So which number of positions that are open without being offsetted or without being going for a delivery is what we would classify as the open interest, right? So that is one clear cut difference that we need to understand between the volume and the open interest with respect to the futures transaction. And typically, now coming specifically to the commodity futures, why are some commodities futures, what kind of commodity futures are beneficial compared to the others? Beneficial compared to the others. See, especially when there is huge amount of economic risk. When I say economic risk, prices fluctuating drastically for a particular commodity. If I see that the prices are fluctuating during a particular period, let's say the prices are fluctuating quite drastically, so there could be two sets of people who could come into it. Let me fix the price. If the price is fluctuating so drastically, let me get into an agreement with someone who can deliver it at a later date at a fixed price, because I want to reduce my risk, because high volatility, high fluctuation probably is more a risky position. So some parties may want to reduce that risk by entering into a fixed price contract with the other party, whereas the other party, they want to take a risk, they want to take an advantage, they want to take an advantage of this fluctuation, and they want to get into a contract in such a way that they will get a profit by taking the risk from the parties who want to avoid the risk. So that is where we see, where there is a huge price fluctuation, we see a group of investors called hedgers who want to reduce their risk. We see a group of investors called speculators who want to take additional risk, and so it's purely a mechanism of risk transfer comes into a picture. So wherever there is a possibility of huge economic risk coming in, we see that the futures market is more successful. Some parties want to avoid or reduce risk, some parties want to take risk. So for that they place some kind of bets, and the hedgers get into those contracts to mitigate their risk. Overall, the futures market is going to be very much successful. But if we see that the prices of that commodity, prices that do not fluctuate, more or less stable, people will be of the intention, okay, even after 6 months the price does not change, increase or decrease, so why should I purchase this particular commodity today and store it? Probably I can very well purchase it 6 months later itself. So that way what we typically see is if the prices do not fluctuate so drastically for a particular commodity, we don't see the need for a futures market at all. And similarly, apart from the prices fluctuating drastically and an economic risk kind of a scenario, we also need to see that the players who want to play in the futures market, some of them they need to be risk taking, some of them they should not be risk taking, they are risk avoiding. So the participants in the futures market also creates a big difference. So just having this brief understanding of this futures market and what contributes more heavily to the commodity of futures market is very essential before we get into any kind of trading activities in terms of the derivatives. If you have any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.